Take a look at Dick's Sporting Goods right now. Down, on pace for its worst day in a year. The stock's down almost 7% now. Dick's pointing a finger at Under Armour. Actually, it was mentioned twice in the news release as for one of the key reasons behind the weaker sales. CEO Ed Stack addressed this in a statement saying, quote, "We experienced continued significant declines in Under Armour sales as a result of their decision to expand distribution." Under Armour has struck a deal with Kohl's, remember, which had called out strong Under Armour sales in its earnings call back on August 21st. Compared to Kohl's, Dick's typically sells inventory at higher price points. Just a little bit of context there. For more on the retail sector, our Mike Santoli joins us at Post 9. That's what the analysts would call a negative read-through.
Yes, no doubt about it. Well, to Under Armour, but also to Dick's market share. I mean, obviously, that's the other part of the equation. Interesting, though, you see that chart of Dick's down 7% today, but up almost 18% year to date.
Sure.
That's the story of retail right now. If you look at the XRT, the S&P Retail Stock Index, this is an equal weighted index, lots of specialty retail in here. Amazon's in here too, but it's less than 2% of the overall. It's up 3.2% month to date, even after being down 1% today, up 13% year to date, up 33% from its low, which was 10 months ago. So the whole story is everybody got comfortable with this idea. People are shopping again, traffic's up, the stocks were very cheap. And I think that's the other piece of it in terms of whether the general strength can continue in retail is, are the stocks cheap enough? Kohl's has had this amazing run. Stock still trades at a pretty good discount to the overall market. Pretty similar story with the likes of Macy's. Even Target trades at a discount to the market and to Walmart. So question here, just a gut check for those companies that can't live up to heightened expectations, or is there something we're going to have to worry about in terms of how much good news has been priced in, half or two-thirds of the way through this year?
Which is the cheapest group? Is it still the department stores? Or
I would say the department stores. Yeah, I mean, Macy's is at under 10 times earnings right now, so the big integrated department stores would be the cheapest. I mean, the likes of Gap have very low multiples too, but because they've stumbled in terms of really taking advantage of this environment in terms of earnings.
People say one of the clues to just what kind of the retail environment we're in is that J.Crew has finally been able, after 4 years, to put some positive numbers up.
It's true. I mean, it's been a kind of a chronic underperformer. The willingness to pay full price a little more often, I think, is one of those things that we don't think about as much, in addition to just kind of wages going up and traffic being better and things like that. So yeah, there's a fashion cycle, there's an apparel cycle that seems to be in motion here. We haven't seen for a little while.
Yeah, it's weird. The only 52-week low we have today is LB.
Right.
Right. I mean, those that are shunned are shunned.
Makes it that much more conspicuous. When you basically can't figure out a whole category, people think the brand is just kind of broken in this environment and things like that. Plus, a lot of stores. I mean, if you have all that much real estate and you're not getting people to come in, it's kind of a big overhang.